students, welcome back. This is Ms. Mercado speaking. This lecture is going to be over Chapter 3, which deals with the adjusting process. This is Accounting 2401, Principles of Financial Accounting, and the textbook that we are using is Financial and Managerial Accounting, 15th edition. Before I start, I do want to let you know that I have a bad cough, but I do need to get these recordings done. So if I cough during my presentation, I apologize, but I'm sick and I need to make these recordings. So I'm just letting you know, FYI. Okay, so Chapter 3 deals with the adjusting process. The information that we learned in Chapter 2 will be applied towards what we're going to be learning in Chapter 3. So it's like building blocks. You need to master Chapter 2 to be able to move on to Chapter 3. If you're having issues, please go back and review Chapter 2, okay? Because Chapter 2 is the foundation for everything that's going to be learned afterwards. The normal balances of the accounts, debits and credits, all of that good stuff, okay? So just a quick overview over the adjusting process. This is information that is provided on your ebook. Okay, so the adjusting process as explained in the textbook. Okay, so basically it explains that at the end of every accounting period, we prepare an unadjusted trial balance, which we learn how to prepare. Okay, and it basically gives you a summary of all of your accounts and the debit and credit balances of your accounts. Okay, now there's some accounts that need to be updated. Okay. Some accounts require some adjustments at the end of the period, which is what the adjusting process handles. Okay, so the textbook gives you some examples of some of these adjustments that need to happen, and that is what the chapter is about, recording various types of end of period adjustments. Okay, so the textbook says that some of the adjustments are some expenses that are not recorded daily. For example, the daily use of supplies would require many entries with small amounts. Also, the amount of supplies on hand on a day-to-day basis is normally not needed. So what usually happens is at the beginning of the month, we say, okay, we have $500 of supplies. The last day of the month, we say we have $200 of supplies. So that means that we've used up $300 of supplies during the month. Okay, so at the end of the month, the last day of the month, we record an entry to update our records, our books, that says, you know what, during this month, we've used up $300 of supplies. Okay. Another example of why an adjustment is needing is for revenue accounts. Some revenue and expenses are incurred as time passes rather than on separate transactions. Okay. For example, they give you here in the textbook rent received in advance. Okay, so you are leasing an office building and they pay you in advance for the whole year. Okay, so you have unearned rent. Okay, so as that rent expires month over month, you can start recording the revenue. Okay, for that you've earned. You can't record revenue if you haven't provided the goods or service. So, yes, you've received money for a whole year's worth of rent, okay, but you haven't provided the rent to your tenants yet. So, as every month that passes, you have to, at the end of the period, record an entry to say, okay, they've already paid me for the whole year. I'm going to take this month's portion and record it as revenue in my books. Okay. Other examples, some revenues and expenses may be unrecorded at the end of the accounting period. For example, a company maybe have provided services to a customer that has not been billed or recorded at the end of the accounting period. So we have to go in there into our accounting records and record those entries. Okay. Another example is maybe your employees have worked, but you haven't paid them yet. You have to go in there and make an entry to accrue for those wages for those employees. They have worked in the month of May, for example, okay, but you're not going to pay them in May, you're going to pay them in June for whatever reason, maybe the cutoff dates of when you run your payroll cycle, but you still need to record in your books how much did they make in the month of May, even if you're not going to pay them, because that is work that was done this month. Those are wages that should have been recorded this month, so we need to make an entry. Okay, so the textbook basically goes on to explain that an analysis and updating of accounts at the end of the period before the financial statements are prepared is called an adjusting process. So we have to go as accountants, we have to go in there and identify what entries need to be made as part of the adjusting process at the end of the month or at the end of the period. The actual journal entries that bring the accounts up to date are called adjusting entries, and that is what this chapter focuses on making adjusting entries. And on your homework, you're going to have a lot of examples of the most common adjusting entries that are done by businesses. Okay. And then the textbook goes on to explaining the two types of classifications for adjustments, which are either accruals or deferrals. And then your textbook defines what an accrual and a deferral is. So basically, an accrual occurs when the revenue has been earned or an expense has been incurred but has not been recorded. Okay, so we are pending to record that entry, so we must do an accrual entry at the end of the month. A deferral occurs when cash related to a future revenue or expense has been initially recorded as a liability or an asset. So let's say the example of the unearned revenue that they have here. So it says here, if the cash received is related to a future revenue, it is initially recorded as a liability. Why a liability? Well, let's say, for example, you have a business and you're renting apartments and the tenants pay you a year in advance. Have you provided the service to the tenant? No. You've only provided the service for the month of January. You still need to provide services for February through December. But they've paid you the whole year. So you are liable to provide a service for the whole year because they've paid you for it. Now, as the service is provided, then you can every month have to make an adjusting entry to be able to record the actual revenue earned for that period. Okay? If cash is paid related to a future expense, that is recorded as a prepaid expense. Okay? So it's just a lot of information. Make sure that you do read your chapter. My focus of this lecture is more hands-on application. I just wanted to provide you an overview of the adjusting process, and this is coming straight from your book. Okay, the textbook does an amazing job at explaining everything. It has great examples, illustrations. So just make sure that before you attempt any of your assignments, that you go and you read the chapter. Okay. So, in your homework, you'll have a problem similar to what I have here, problem 3.1a. Okay, and this problem I selected it because it's basically a whole bunch of adjusting entries that we need to do. Okay, now your homework starts off by doing one entry at a time. Those exercises are very short. Now this puts everything together, a whole bunch of adjusting entries that need to be done at the end of a period. So it says, on March the 31st, the following data were accumulated to assist the accountant in preparing the adjusting entries for Potomac Realty. And then they give you 5 different transactions. They're asking you to journalize the adjusting entries required at March 31st. So we are doing end of period adjustments as of March the 31st. Okay, so that is the first requirement that we're going to tackle. So let's read over the first bullet. Okay, so it says the supplies account balance on March the 31st is $5,620. The supplies on hand on March 31st is $1,290. You know what? To help you illustrate, let me create a T account. Okay, I like using T accounts because it provides us with a visual of representation of what the balances in our accounts are. Okay, and let me just do this real quick for you. That way we're able to see it. Okay, and then maybe I'll just copy it down. Copy that. That way if we need to show it, we'll have some examples here. Okay, so let's work on the first one. So the first one that we're talking about deals with supplies. Okay, supplies is an asset. If you buy the supplies belong to you. Okay, so I'm going to put the word supplies here, and I'm going to merge it. Okay, and they tell you that as of March the 31st, you have a balance of $5,620. Okay, the supplies account balance on March the 31st is $5,620. The supplies on hand March 31st are $1,290. Okay, so we have supplies of 5,000. Excuse me here with my mouse. 5,620. Now supplies is an asset account. Okay, this is an asset. Okay, the normal balance of an asset, by now we should know an asset has a normal balance of a debit. Okay, so this is my beginning, the balance. Okay, this is your balance, beginning balance. Okay, and then it's saying that at the end of March, you only have 1,290 left. Okay, so where is that 1,290 going to go? Well, that's your ending balance. Okay, so here we have my ending balance. Okay, so I like to show it like this. Let me just write a line here. Okay, so my ending balance is $12.90. Okay, so we went from having 5,620 in supplies to having 1,290. So if we went from 5620 to 1290, what needed to have happened to this account right here? Okay, so would you debit it or would you credit it? Okay, now let me enter. Okay, now this is an asset account. If the balance increases, you debit. If the balance decreases, you credit. Okay, so this is the account supplies. Let me highlight it for you guys. Okay, so my beginning balance is 5620. My ending balance is 1290. Did your balance increase or decrease? Well, my balance decreased. So I know that I need to post an entry on this side. Okay, well, how much is that entry going to be? Well, let me get my calculator out. Okay, so I know that I started with 5620 and I know that I ended up with 1290. So that means that during the month I used up $4,330 of supplies. Okay, so that entry needs to go on the right hand side to be able to make your supplies T account balance. So my beginning balance was 5620. I used up 4330, and that's a decrease because you used it. So now my ending balance is 1290. Okay, so that is the amount of your adjustment right there. Okay, that is your adjustment amount. Okay, so now that you see how we started off with 5620, we ended up with 1290. This is the adjustment. We're going to go and we're going to record the adjustment. Okay. Okay, so these are dated March the 31st. Okay. Now, what are we going to debit? Okay, so there's two accounts that are affected. Okay, the first one is your asset account. So what is happening to your asset account here? Well, your asset account is decreasing. Okay, so your asset account is decreasing. The offset to it, let me see if I can copy and paste this. Okay. So, I don't need any of this. Now, my offset to this entry, we need to figure out where am I going to offset this transaction, okay? So I know I need to credit my supplies account for 4330, okay? But what am I going to debit, okay? Remember, debits must always equal credits, okay? That's the rule of accounting. Debits must equal credits. Okay, that's making it smaller. There we go. Okay, so I know that my supplies account decreased. Well, then you used up supplies during the month. So what does that represent? Usually when you have or you're decreasing an asset, like in this case supplies, you're going to have an account to offset it with. That's an expense account. So in this case, we're going to have a supplies expense account. Now this is an expense account. Okay. The normal balance of an expense account, you increase it by a positive or a debit, and you decrease it with a negative. So what's happening to your expenses? Okay. Well, you used up supplies during the month, so your supplies expense is going to increase. So then you're going to have an increase of $43.30 to your supplies expense account. Okay. So then your adjustment is going to be a debit to supplies expense and a credit to supplies. Okay. So supplies expense, well, the expense accounts are debited all the time, $43.30, and then your supplies asset account decreased. You have less supplies now. Okay. And the description is going to be supplies used, and we got that by getting the 5620 minus the 1290. Okay. So that's the first adjustment that we have. Okay. The second adjustment that we have, it says the unearned rent account balance on March the 31st is $5,000, representing the receipt of an advance payment on March the 1st for 4 months rent from the tenants. Okay? So, it's saying that they paid you $5,000 for 4 months worth of rent. Okay? And they're paying you in advance. So the first thing that we need to figure out is, well, how much did they pay me monthly? Well, let's get my calculator. I know that I paid, or that I received $5,000 in rent for 4 months. So that means that my monthly rent is $1,250. Okay, $1,250 is my monthly rent. Okay. So, unearned rent. Unearned rent. We're going to merge it. Okay. So my unearned rent is going to be, I misspelled earned. Okay, here we go. Unearned rent. So my unearned rent balance is $5,000. Okay. This is a liability. Why? Because I owe a service to my customers or my tenants. You know what? They paid me in advance. Now I need to provide them with, an office space for the next 4 months. Okay. So my balance is $5,000. Okay. Okay, and then let me copy this down. Now the second account that we have, let me undo that. Let me just copy this. Okay. The second account that we have is rent revenue. Okay. Now remember, you cannot record your revenue the month that you receive the money. Yes, you received $5,000, but you haven't earned it yet. Okay? You have to record the revenue as you earn it. So every month that passes that you provide the service of, the person having access to that office building or whatever is it, the apartment building, whatever you're leasing, as they use up the monthly rent, then we, the business, have to record that revenue in our books. Okay, so when we receive that $5,000 check, well, we got cash. Okay, cash increase, and then we went ahead and we recorded an unearned rent of $5,000 in our books. Okay, now it's saying that that happened on March the 1st. The whole month of March has passed by. So now that for that whole month of March, the rent has been used up. So that represents 1 month's worth of rent. So we had said that 1 month's worth of rent was $5,000 divided by 4. 1 month's worth of rent is $1,250. So now we have to reduce my unearned rent by that amount. Okay. So now I'm going to debit my unearned rent by $1,250, and that's going to leave in my books $3,750. This is going to be the adjustment, okay, of $1,250. So that means that during this month of March, I was able to provide a service, and I'm going to reduce my unearned rent because you know what? The rent has been earned already. I've earned $1,250 worth of rent. So yes, you had a liability of $5,000 to start off with. That's when they gave you that $5,000 check. Now this month, I've earned a portion of it. I've earned 1 month's worth of rent, which is $1,250. That leaves me with $3,750 of unearned rent, which is for the next 3 months. Okay. Now the debit goes to unearned rent. Okay. What are we generating? Well, we are generating rent revenue. Okay. We are renting an office space, and now that I've actually provided my service, which is provide them with an office building for the month of March, I can actually record my revenue. Okay. And for the revenue account, the normal balance is a credit. And so in this case, my revenue is increasing. Okay. So your revenue is increasing. So I'm going to go ahead and I'm going to credit my rent revenue. So the first column is always debit. The second one is always credit. So what's going to happen here, okay, is I'm going to go ahead and I'm going to record a debit to unearned rent because now I've actually earned it. So I have to reduce my unrent balance by $1,250. And I'm going to record my rent revenue of $1,250. I have a debit and I have a credit. Okay. So it's unearned rent of $1,250. And then I have rent revenue of $1,250. And then this is rent earned, and it's the $5,000 divided by the 4 months. And that's going to give you your monthly rent. Okay. So that's the second entry. The third entry, wages accrued but not paid. Okay. Wages accrued but not paid at March 31st are $22.90. So what does this mean? This means that employees worked during the month of March. Okay, we know how much they worked, we know how much we owe them, but we're not going to pay them till April. Okay, so we're going to accrue for those wages. That way next month that we pay them, you know what? Yes, we're going to take the money out of an account, but the expense was actually recorded in the period that it was incurred. So if the employees worked in the month of March, we have to record those wages as of the month of March. Okay, so whenever that happens, okay, we're going to go ahead and we're going to debit an expense account. We always debit an expense account because we need to record in our books how much did we spend in wages this month, regardless if you've paid or not. We always want to know how much was used up, or how much was charged, in this case for wages. How much do we have to pay our employees for work that they did in the month of March? So we have wages expense of $22.90. Okay. So we need to record in our books that during this month our employees earned $2,290 this month. Okay. Now we're not going to pay our employees this month. We're going to pay them next month. So because we are going to pay them next month, I'm going to put the money aside on an account called wages payable. Okay. The word payable means it's a liability. I owe money. Okay. So what this means is me, the company, owes money to my employees for wages. Okay. The normal balance of a liability account is a credit. Okay. So wages payable, anytime you see the word payable, it's a liability and it has a normal balance of a credit. Okay. So I'm going to go ahead and I'm going to credit wages payable. And these are my accrued wages. So what we did here is we recognized the expense in the period that it incurred. My employees earned their wages in the month of March. We're going to record the wages expense in the month of March, whether we've paid or not. Because we haven't paid, then I'm going to put the money on my wages payable account. Okay? And whenever I'm ready to cut my check to my employees, I'll just take the money out of my wages payable and voila. Okay? So that happened on the 31st. The next one, number 4, it says fees accrued but unbilled at March 31st are $16,825. So fees accrued but unbilled at March the 31st. Okay. So it says fees accrued but unbilled at March the 31st. So what this means is that they're accruing for you went out there, you perform a job, okay, but you haven't billed your customers yet, okay. So you've performed the service, okay, but you haven't billed them yet for whatever reason. You haven't billed them yet, okay, but you've already provided the service, okay. So to record that, we need to send out invoices to our customers. This is unbilled. So at the end of the month, I need to say, you know what? I have $16,825 worth of services that I've rendered, but I haven't billed it out. I haven't gotten paid yet. I need to record that in my books. Why? Because those $16,825 in fees were earned this month. So if it happened this month, regardless if I get paid or not, I need to record the entry this month. Okay? So this is happening on March the 31st. Okay? So I need to set up an accounts receivable. Why do I need to set up an accounts receivable? Because these customers haven't paid me. So I need to set up a receivable. That way I can keep track of who owes me money. So I can call them up and say, hey, you owe me money, you need to pay me. So an accounts receivable is an asset account. The normal balance of an asset account is a debit. And that is for $16,825. Okay. Now, what are we accruing here for? For unbilled services. Okay. So I'm going to go ahead and I'm going to credit my fees earned. Okay. I've earned these fees. I've already provided the service. I've done the job. I've earned the money. It's just that I'm waiting for my customers to pay me. Okay. But I'm still going to record my fees earned this month because this is the month where I earned the fees. Okay. So my the amount is $16,825. Okay. Remember, debits must equal credits. And this isn't going to be an accrual. So it's going to be accrued fees earned. Okay. The last transaction we have is the depreciation of office equipment. Okay. Depreciation, it just means that the asset loses value because of its use. Okay. You're using something up, it's just depreciating. It's losing value. Okay. So it says they're giving you the amount of the depreciation for the office equipment of $4,600. Okay. So whenever we deal with depreciation, there's two accounts that are affected. Okay. We have depreciation expense account and we have the accumulated depreciation. Every account has its own depreciation account and or every accumulated depreciation account. So let's say, for example, you have equipment, you have trucks, you have different things. You're going to have accumulated depreciation for each of the different categories. Okay. So in this case, we have a depreciation for office equipment of $4,600. Every time that you depreciate something, an entry needs to be posted to record the depreciation expense. Okay, so the depreciation expense that they gave you here was $4,600. Okay, so we debit depreciation expense and we always credit accumulated depreciation. And this is for the office equipment. Okay, $4,600. So whenever something gets depreciated, an asset gets depreciated, you will always debit depreciation expense. You will always credit the corresponding accumulated depreciation office equipment or equipment account or whatever account it is. But accumulated depreciation will always be credited. Okay, depreciation expense will always be debited. Okay, so those are the entries that the 1, 2, 3, 4, 5, the 5 adjusting entries that we were required to journalize in this problem 3-1. Okay, now I just like to be precautious and I want to make sure that my debits equal my credits. Okay, remember, if they don't equal, then we need to do something about it because debits must always equal credits. Okay, and we do. Okay. So that is the first requirement. The second requirement says, briefly explain the difference between adjusting entries and entries that would be made to correct errors. Okay. So basically, okay. Okay, so let's put the answer right there. So they're asking us to explain the difference between adjusting entries and regular entries to correct errors. Okay, so basically adjusting entries are a planned part of the accounting process used to update the accounts. On the other hand, correcting entries are not planned but arise only when necessary to correct any type of error. Okay. So, adjusting entries is just a planned process. At the end of the month, we need to identify the accounts that need to be updated. We get them done and we move on. Okay. Now, correcting entries, those happen because we made a mistake. We posted a transaction for the wrong amount. We transposed the information, whatever the case might be. Okay. So, correcting entries might be needed in case an error was made. Okay. So that is the first problem that I went over. It's a little bit of summary of how to do adjusting entries. Now the next problem I'm going to be going over is problem 3.4. So let's read the problem. It says, Goodnote Company specializes in the repair of music equipment and is owned and operated by Robin Stahl. On June the 30th, the end of the current year, the accountant for Goodnote prepared the following trial balance. And then they give you the trial balance information. It says, journalize the 7 entries that adjusted the account at June 30th. None of the accounts were affected by more than one entry. Okay, so that was the problem. Now what I did is I went ahead and I copied all of that information into an Excel spreadsheet. Okay, so I just copied and pasted this information over here. Okay, oh, sorry about that. Now what we're going to do is, once we have that information, okay, I just copied and pasted, and now I have my unadjusted and my adjusted balances. Okay, now what did they want us to do? Let me see. Journalize the 7 entries. None of the accounts were affected. Okay, so we just have to figure out what adjustments need to be done at the end of the period and what adjustments need to be recorded so we can update our records, okay, our books. So what I did is I copied the information just like you see it here over here. I didn't do anything about it. The $1,250,000 balance, the $1,278,200 balance. All I did was copy and paste. Okay. Now we need to figure out, well, what caused our balances to change from the unadjusted to the adjusted balance. Okay. So what we do is we're going to go through each item and we're going to see if it went up or down. Now I'm using Excel. Okay. So to me it's just a lot easier if I do, I'm going to get my adjusted column minus my unadjusted column. And I'm putting it on the debit because my balance is on the debit column. Be very careful with that. So I didn't have any changes to that account. Okay. Once I put that first formula, then this little corner box pops up. I'm just going to grab it, bring it down, and that's going to populate the rest of my fields. Okay. So it automatically does the calculations for you. Okay. We're going to do the same thing with the credit. I'm going to get my credit for my adjusted balance minus the credit for my unadjusted balance, and it's going to give me a number. And then I just grab the little box here at the end and drag it down. Okay. So if you notice, my debit equals my credit, my debit equals my credit, 28,200, 28,200. Okay. So what I did here is I got the difference between my adjusted and unadjusted balance. So let's look, for example, at this one right here, supplies. Okay. On your unadjusted, you had in supplies $11,250. At the end, you had $2,400. So that means that you used up, let me see. Okay, so we had $11,250 minus $2,400. So that means that we used up $8,850 in supplies. Okay. So all I did was get the difference between my adjusted and my unadjusted. And if we didn't have a difference, then just leave it blank. Okay. So now here, I have an entry to supplies, or a difference of $8,850. So what happened to your supplies? Well, your supplies decreased. Okay. You went from having $11,250 to having $2,400. So your supplies significantly decreased. Okay. So now what I'm going to do is we have to record that entry for the supplies. Well, what happened to the supplies? Well, the supplies got used up during the month. Okay. So the supplies got used up during the month. Okay. So we're going to focus only on the one that have differences. Okay. So I notice here that I have a difference of $88.50. So my supplies went down. They decreased from 11,250 to 2,400. Okay, so that's a decrease of 8,850. Okay, now what else happened? My supplies expense. Okay, supplies expense, I started off with 0. At the end, I had 8,850. So my supplies expense increased by 8,850. Okay, so we have a match. The two accounts that are being affected are supplies expense and supplies. Okay, so my first entry is, this is dated June the 30th. Okay, so we are going to, what's happening to our supplies? Is it going up or is it going down? Our supplies is decreasing. And we said the supplies was decreasing by 8,850. Okay. Now, supplies decreased. Supplies is an asset account. You debit when you increase, you credit when you decrease. And in this case, we are decreasing the balance from 11,250 to 2,400. So we have to credit it to decrease it. Okay. Now, what's my entry going to be? Well, I used up the supplies. Okay, I used up the supplies. Okay, so whatever you used up with this for this month, what does that represent? Okay, so this is happening June the 30th. Well, my supplies expense increased by 8,850. An expense account increases with a debit. Okay, so we're going to debit supplies expense of 8,850, and I'm going to credit supplies for 8,850. Okay, so your supplies decreased, your supplies expense increased. Now let's look at the next one. Prepaid insurance. You had $14,250 and the adjusted balance was $3,850. So we saw a significant decrease of $10,400. Okay, so that is my balance. $10,400 difference. So I started off with $14,250. I went down to $3,850. So I decreased by $10,400. Okay. So now we're going to record that entry. Let me color code it. Okay. Now I'm going to look for an offset. There always has to be an offset. And in this case, we have an account called, and I misspelled it, insurance expense. Okay. So what happens with insurance? In businesses, usually we prepay a whole year in advance. Okay. So we set up a prepaid. Okay, which is an asset account. Okay, as we use up the insurance, we expense the portion that has been used. So every end of period, I have to record an entry to remember to say, you know what, I need to update my records and I need to record my prepaid insurance. Why? Because this month I've used it, so I need to account for it in my books. Okay, so let me put a little description here. Supplies used, 11,250 minus 2,400. Okay. The next entry we have is the one for 10,400, and my prepaid insurance decreased by 10,400. My insurance expense increased by 10,400. So what am I going to debit? I'm going to debit insurance expense. Okay. That was for 10,400. Okay. Now, when we set this up, we had an account called prepaid insurance, and it decreased. Okay. So what's going to happen over here to my prepaid insurance? It's going to go down. Okay, so we have our prepaid insurance decreasing, or my prepaid insurance is decreasing by 10,400. My insurance expense is increasing by 10,400. $400. Okay. And my description is insurance expired. This has been used. That's $14,250 minus $3,850. Okay, the next one we have is accumulated depreciation equipment. Okay, so my accumulated depreciation increased. We went from $94,500 to $106,100. So my balance increased. Okay, now your accumulated depreciation equipment increased by $11,600. Now accumulated depreciation is a contra asset. The normal balance is a credit. Okay, now my offset is going to be depreciation expense equipment. Okay, so we are going to offset that to the entry right here for depreciation expense equipment for $11,600. So accumulated depreciation needs to be credited. Okay, so we have accumulated depreciation for the equipment, and that amount is $11,600. And then what am I going to debit? Well, let's look over here. The debit belongs to my depreciation expense. $11,600. Okay. So here we're going to go ahead and we went from 106. This is my equipment depreciation. And we went from 106,100 minus 94,500. And that's how we got 11,600. Okay. So that's been used. Now we have this one right here. 7,300, 7,300. Okay. So the same thing, but now we're depreciating an automobile. Okay. So June the 30th. Depreciation expense auto went from 0 to 7,300, so that increased 7,300. So I'm going to show that increase to depreciation expense auto by debiting the account for the $7,300. Okay, $7,300. So, and then we're going to go ahead and we're going to offset it against accumulated depreciation. Okay. And that is going to be the $62,050 minus the $54,750. Okay, so that is the fourth entry. And don't forget to enter your amount. If not, you're not going to be in balance. Okay. The next one we have is this entry for $1,200. Okay. What is that entry for? Where if I look down here, I have another entry for $1,200. One's a debit, the other one's a credit. And it is for utilities expense. Okay. So what does this mean? That means that you received your light bill, your water bill for services for this month, but you haven't paid them and will not pay them till next month. So you have to accrue for those expenses, for those utility expenses, okay? You need to record it in your books that they were paid even though they were not paid, okay? But we need to record our transactions when they are incurred, okay? So in this case, Utilities expense will be debited for the 1,200. Okay, why? Because it increased. You went from 12,900 to 14,100, so your balance increased by 1,200. Okay, and then we're gonna have accounts payable. So what does that mean? Accounts payable is used when we owe someone money, someone in our business, like a vendor money. Okay. So everything sitting in my accounts payable is money that has already been recorded. We're just waiting to take the money out and actually distribute it. In this case, write a check out to your utilities company. But the money is already going to be sitting in the correct period in our books. Okay. The next entry we have this $8,100 for salaries payable. Okay, $8,100, and the offset is going to be your salary expense. Okay, so these are salaries that have been earned but not paid. So we have $8,100 sitting in a salaries payable account waiting for them to pull the money out. Okay, now every time that you do an entry or an adjustment, most of the time, like in this case where it's salaries payable, you know that your employees worked and they earned that money that you should have paid them this period, but you're gonna hold off and pay them till next period. Okay, so we're gonna go ahead and we're gonna record that entry. Okay, so what happened? Well, your salaries expense went up from $516 to $525. They went up by $8,100. So I have to record that increase in my account. Okay. So here we have salary expense. It increased from $516 to $525. So I need to record a salary expense account. For the difference, which is $8,100. So the difference between $516 to $525 is $8,100. Okay. Now, are we paying our employees the salaries this month? No, we are not paying our employees this month. We're going to pay them till next month. So we have to put the money aside in an account that will allow us to do that in the future. And the account that we use is salaries payable. Okay. The amount is $8,100. Okay. And this is accrued salary. And how we got accrued salary? $525 minus $516,900. Okay. $8,100. Okay. Okay. Next, the last transaction that we have, okay, is for $9,000. Okay. So the last transaction we have is for unearned service fees, $9,000. So if we look here, we had unearned service fees of $18,000. Now my balance is my adjusted balance is $9,000. So that means that we should have recorded an adjustment for $9,000. Okay. So let me get another color. I put the wrong. I should have been highlighting. Okay, here we go. Okay, $9,000, $9,000. Okay, so unearned service fees. Okay, you went from 18 to 9, so that is a decrease of 9,000. Okay, here we have service fees earned, 9,000. So an adjustment needs to be made to bring these two accounts to their normal balance. Okay. So that's happening as of July the 30th. Okay. So we're going to go ahead and we're going to debit my unearned service fees. Okay. So my unearned service fees are going to be decreasing. My normal balance is an asset, a debit. Debit increases as credit decreases. In this case, I'm decreasing my balance, so I'm going to credit my what account is this? Unearned service fees. Okay. So unearned service fees is going to be debited, and then we're going to credit service fees earned. Okay. And the amount provided here is $9,000. Okay. So it'll be $9,000. There we are. That is the last adjusting entry for this problem. If you see, I've highlighted all of them. I've matched them up by color to know which one goes with which. Okay. Because we need to ensure that all of our numbers are used. Okay. And then at the end, I'm just going to make sure that my debits equal my credits, because if they don't, at the time that I enter all of this information into my journal, it's going to give me some kind of error message. You're going to try to figure it out. So it's better just to double check that your debits equal your credits. Okay. And it does, $56,450. Okay. So let me just double line that. There we go. So my debits do equal my credits, and all of the adjusting entries have been recorded. Okay. So in this particular chapter, okay, let me just enter a description here. This is service fees earned. Okay. Okay, so this is the journal entries. These are the adjusting journal entries that need to be done every end of period. Okay. Now remember, all I did was I obtained the information from the problem. I put it in Excel just to make it easier for me to see and understand. Okay. And then I went ahead and I recreated with the information they had here to make it easier for me to do my calculations and figure out what the balance was between the unadjusted and the adjusted trial balance, so I can present to the let me see. God, I lost my train of thought here. So basically, okay, so this is the problem. These are all of the entries that need to be done. Make sure the debits equal the credits, just to make sure that all of your transactions are in balance. We don't want to move forward into doing our financial statements not being in balance here. Remember, every entry needs to, debit and credits need to equal. Make sure, like I was saying, here all I did was transfer the information over from the problem over here, just so I can run my calculations easy, and then you just match up the numbers. Okay, well, if this one matches with this, well, what happened? Well, my depreciation happened. I know that I need to increase my depreciation expense by debiting, and then I need to credit my accumulated depreciation for the $7,300. Okay, so just match them up, and then once you match them up, you can figure out your different adjustments. Okay, so there's a lot of information covered in this chapter. Make sure that you read the chapter before attempting your problems. If you have any questions when you're working out your problems, please do not hesitate to contact me. Make sure that you include your name, the problem number that you're having issues with, your attempted solution, so I can review it and provide guidance. Okay, make sure that you review your syllabus weekly and you keep up with all of your assignment deadlines. Please stay organized. Please stay focused. Okay, so that is basically it for this video lecture. Until next time, take care.